This graph shows percentage population lives on less than $2 a day in 2009. As you can see, most people are concentrated in developing countries or less developed countries, and those people might not have seen those food, water, healthcare, education, and business before. Even the same stuff with low quality, they need help from financial inclusion to get them. Throughout my presentation, I will be talking about the concepts of financial inclusion, how it works, and why is it important, the models of financial inclusion providers, which are government, business, and non-government organizations, 4-country comparison for informal financial services based on mobile banking, the recommended action for achieving more financial inclusions. Financial inclusion is to provide a broad range of financial services, such as deposits, loans, payment services, money transfer, and insurance to poor and low-income households and their micro-enterprises who have no access to appropriate financial products and services. This includes having no capacity, skills, knowledge, and understanding to make the best use of those products and services. There are 3 types of financial inclusions. The first one is informal financial inclusion, which is community or village organized financial activity, member-owned and operated like savings group. The second one is semi-formal financial inclusions. Usually it's registered business, often member-owned like non-government organization. The last one is formal financial inclusion, registered and meets financial regulatory requirements like the bank. Our research is more focused on informal financial services, because there are more than 2.5 billion people who have no bank accounts or insurance, services which can make the difference between surviving and thriving. Most people don't use formal financial services. It's because they don't have enough money, and the fee to maintain a bank account is very high. If people live in rural areas, they don't have access to the bank, and some of them don't have necessary documents to open a bank account. More importantly, some people don't trust banks. Instead, people are using informal financial services, since they don't have access to formal financial services. And the crucial problem for poor is that their income is not only low, but also irregular and unreliable. For example, an annual average income of $2 a day may range from a high of $5 to low days when no income is earned. For farmers and others with seasonal occupations, variations over a year can be even greater. There are 3 most common informal financial organizations in the world. They are all composed of a small number of people who save together and take small loans from those savings. Those 3 financial inclusions have proven to be one of the most effective, low-cost mechanisms to provide basic financial services to the poor, particularly in rural areas at a very large scale. The most common financial inclusion providers in the world are government, business, and NGOs, but their planning and decision-making are distinct. Here's the model for the government. Civilians come with a proposal, and next the Senate will evaluate the proposal and bring the result to the upper level. Then, the executive and the legislature will decide which proposal will become the policy or the laws. Since the government is the lawmaker, so it can subsidize or intervene to help the citizens, and sometimes by using laws. Business, on the other hand, make decisions by how much profit they can get, so all the employers will determine which plan will be profitable. Then they will test it in small areas, assess the result. If the result is pretty good, they will apply the products and services to all the customers. And they can use corporate social responsibility and strengthening agency banking to approach financial inclusion. For NGOs, they have the same model for many years, so they just create community, teach the members to save money, and lend it to the group members who need it. After the borrowers pay back both the principal and the interest back, group members will get a dividend from it. Although NGO is the biggest financial inclusion provider, it can only help others by using social obligations and donations. Government, business, and NGOs are all financial inclusion providers, but the strategies they are using are totally different. The government wants to apply the policy to all the citizens. However, business is more focused on getting profit from their customers. An NGO is paying much attention on people who live on the base of the pyramid. This graph shows the mobile phone ownership by countries. As you can see, China, India, South Africa, and Brazil all have a mobile phone penetration more than 70%. Today, the usage of cell phone is becoming more and more common throughout the world. Out of the world, estimated 7 billion people, 6 billion has access to cell phones. Since the mobile phone penetration is high, some countries use cell phone as bank account because those 4 countries are top 10 about percentage population using mobile banking in the past 6 months, and they are all developing countries. So it might help us understand how mobile banking eliminate the poor. Why mobile? Mobile devices reduce costs by 50 to 70%, making it possible to produce financial inclusion to vast populations. Access to financial services lowers the costs of sending and receiving, improves safety and security, and makes the payment more convenient. More importantly, it promotes savings and borrowings. For China, there are more than 40% of mobile banking users worldwide, more than 100% growth in mobile banking users, and more than 300% in transaction values for major commercial banks in 3 years. India's largest private bank have launched M-Pesa, which will allow more than 700 million unbanked people in India have access to financial inclusion. For South Africa, the mobile banking users has been increased by 12% last year. In Brazil, many Brazilian banks cooperate with telephone companies to provide mobile banking services to low-income individuals who currently lack access to financial services. There are so many financial inclusion providers in the world trying to eliminate the poor, while there is still more than 50% of people live on less than $2.5 a day. Since the financial understanding or information between providers and consumers are not enough, research shows that women and young people are more likely to be excluded than others. Formal financial service providers don't cater to the poor, and there are still many people live far away from the banking services. The transportation and transaction costs for the poor is still too high. More importantly, some policies inhibit poor people involved with the financial inclusion. But there are several recommendations for breaking the barriers to financial inclusion. Ensure financial inclusion is part of the development framework. Recognize savings groups as a springboard to financial inclusion. Also, build bridges between informal and formal financial sectors. Invest in and expand access to financial literacy. Furthermore, develop strong checks and balances to protect poor and vulnerable people. As concluded, the right way to build financial assets is through savings, rather than debt, because savings groups provide a valuable source of funds for consumption and investment need, and also meet the social needs of communities. So, go through this bridge. People might get out of poverty,